Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, November 1st, 2017. I wanted to do a quick market update on a couple of some of the things I'm watching for in the broad markets, as well as a couple of the sectors and commodities that stand out to me. Keep in mind, I often talk about my preference to trading the individual stocks over the broad market, and at times I will trade the broad market. We haven't seen a lot of official trade ideas lately, and now, there are some interesting developments, and I wanted to go over that here. I've talked about this recently. I covered this on a front page post today, talking about the FANG stocks, the market leading FANG stocks that make up nearly half of the returns of the NASDAQ 100. Um, and how you can see here, and again, this was on the front page. And I imagine if you're listening to this video, you probably already read that post, and I had the performance cited there, since and this is going into the close yesterday. Facebook is up another, oh gosh, it was up 1% earlier. But as of yesterday, we had, of course, last Thursday, I should back up, and we had Amazon, Facebook, I'm sorry, Amazon, Microsoft, and Alphabet all report. And I gave you the stats, Amazon through yesterday, since reporting after the close on Thursday. So just the performance from when the market opened on Friday until today. I'm sorry, until the close yesterday, just a few days of trading. Amazon rallied about 12.8%. Microsoft, it was up, and these aren't to the peaks, just to where they closed yesterday. Microsoft up about 4.9, Alphabet 4.5%. Yet Facebook rallied 5.4, and again another percent today. Apple 7.8 into yesterday's close, and those numbers are right in line, even actually probably a little bit above the average for what the other three fangs did, and they didn't report. And the thing is, you can check the news. I didn't do it, but I can tell you with near certainty they caught a sympathy bid. And as I posted this in the trading room today, I think there were two things that happened. We all know that this market in recent years, there's been an unprecedented trend towards index investing, meaning both professional money managers, institutional funds, even hedge funds, but mostly, more so not the hedge funds, the individual mutual funds, retail investors all going into index funds because that was the whole big thing that you can't, it's too hard to beat the market. And so we've seen the pendulum swing to an extreme with a lot of index investing. Now, where I'm going with this is you have the index funds, and NASDAQ 100 is one of the most popularly traded. In fact, tech has outperformed. So it stands to reason. And we all know the retail investors chase returns. They don't get in front of returns. They tend to pile into the top. So therefore, we know the NASDAQ 100 and QQQ and then NQ E-mini futures that track the NASDAQ 100. We know that both individual investors as well as retail the institutional funds, mutual funds, pension plans are chock full of those. And as indexing works, when you have money flows into or out of an index, so say the QQQs here, for example, all the stocks within there are going to be bid up or bid down with the inflows and outflows. So it's hard to argue. The QQQs saw a ton of volume right after those first three FANG stocks beat last week, and you can see the charts are extremely clear. There was no rally. In fact, all the Apple, everything else had kind of stalled down up until that point. So I think it's very hard for one to argue that they caught a sympathy bid. Now, I think there's another component too. I think that a lot of market participants made the assumption that, well, if Amazon and Microsoft and Alphabet blew it away, then it stands to reason that Facebook and Apple are going to blow it away too. First of all, that logic is not very sound because these companies have completely different business models. They have different fundamentals. Yes, are they all somewhat related in that techosphere? Yes, to a lesser extent Amazon, but either way, they're tech companies, but they do different things and they have different fundamentals that impact each company. So therefore, I think that logic is flawed. Now, let's say you accept it and it's all good and they are going to blow it away. Well, again, I just stated that they've now rallied about as much as the three fangs that blew it away. So therefore, how much more upside is left on a positive surprise? Because if you go with the price discovery, which is a term in the markets that all known variables are factored into a stock. So just a few days ago, last week, before this big ramp in the market, if you assume that Apple and Facebook were both reasonably priced, again with all known variables at that point in time, now they've just had a 6% plus 6 to 8% pop since then on without any fundamental catalysts or other news being reached, how much more upside is there? So the reason I'm doing this is trading is all about getting an edge. I am not adding an official short. I'll let you know that I am short the Qs, but I am not adding that as an official short because there's that very little evidence other than I see a pretty attractive risk reward, meaning over the next week or so, after Facebook and Apple get out of the way, after earnings are out of the way, which will be after the close tomorrow. Remember, Facebook reports tonight, Apple reports tomorrow after the bell. So then, as of Friday, we're all clear. All five FANG stocks will have reported. And then I see, in other words, very little, minimal upside to the market, even if they blow it away. Meaning we may still go up another. The QQQ could go up 2, 3, 4, maybe 5% in the next week or two. I very, very much doubt it will climb that much based on the charts and how much it's risen recently. However, should they disappoint, should those two companies or either or come in and disappoint, I think the potential for the downside is a whole lot higher than the upside potential in the market because again they've already priced in what would seem to be a very, very rosy and optimistic, both an earnings beat and as well as a optimistic forecast. All right, with that being said, I don't want to beat a dead horse. You know my thoughts on the market there. Um, Now let's look at some of my favorite sectors to trade. I was going to jump over to the sectors, which I will, but as I flip to another tab here on my charts, I was already on Apple, and there's Apple. Of course, there's everything. Nothing's changed in Apple for a long time. We have the P PPO, that trend indicator has slightly, it is crossed above, so it's back now into bullish territory. So that was a little whipsaw signal there. There's Apple. You can see we still have this divergent high from this point here all the way up here. You can see the PPO moving down, the RSI moving down. So there's still that divergence. And again, let's just see what happens after they report on Thursday after the bell. See how they trade into Friday and early next week, and then we'll have a better idea where Apple goes. Just a quick side note here, if you want to look at Apple, we're going to report Thursday. These lines are the last two earnings report. This one was on August 1st, and this one before that was on May 2nd when they reported. And so you can see what happened here. You didn't have that ramp that you did before. Apple was steadily moving up, but then faded a lot, about half of that rally just before they reported, traded sideways, which is often the case. And again, guys, I haven't done a lot of market analysis this week because we have been and will be in a holding pattern. We were in a holding pattern last week to the first three things reported, boom, then a big pop. I stated we'd go, there'd be some volatility one way or the other. The volatility was to the upside, the big price move. And then again, we've traded pretty much in a holding pattern now waiting for Facebook and Apple. But you can see here, so we rose a little bit, sold off, and then we gapped up. Interesting to note, there was the gap. Apple moved higher for a while, but faded. And there's technical analysis for you. Faded 100%, an almost near perfect fade. I'm talking from this point here after, we had a little pop after the earnings and then we dropped right back to backfill the gap. And as I often say, most gaps are eventually backfilled at some point in time. So that would have been obviously an objective long in hindsight looking at this chart. But I just want to show you that that's what happened. And here was the May 2nd report. We had just, a little bit sightward up sideways to a slightly upward bias. We popped immediately, peaked just about a week or so later, and then once again faded all the gains and then some before moving up. So the bigger picture, sure, it's certainly in an advance, but keep that in mind. And again, we didn't have, here's the point I'm trying to make, leading up to those reports. We had mostly sideways action here for the most part from this earnings to this one, mostly sideways action. Again, we're a little sideways to slightly upward bias, but all of a sudden we've had a big ramp up here. So again, this speaks to how much more upside is left in this. This is the world's largest company right here. To see a move like they've just had at 8% in just well, what is that, 2 or 3 trading sessions to see another 8%? Has it happened before? Probably if I go back in time, but I can tell you it's very unusual. So I remember just the other day, member at Joe Friday in the trading room mentioned, uh, you know, questioned maybe putting a short on Apple here just as a speculative play, buying some puts. And I agree, the upside potential from here, I think, is paled or shadowed by the risk for an unexpected downside move, even if we came back into where we were just before that rally. So those are my thoughts. Again, that's not an official trade. Do what you want with both Apple and the broad markets. Let me give you some other sectors and things that I'm looking at. I'm going to jump over to wheat because I haven't covered that in a few weeks. Now, wheat was an official trade, and before it got stopped out, I had a stop here on a daily close below 640, which was stopped out a while ago. I made mention. I don't know if I took it off on the site, but I made mention at the time. And even in my updates, I said, look, based on this action as we're coming down here, I said they're probably going to run that stop. It's probably going to get stopped out. I'm not going to revise or extend the stop. And at that point, what I was favoring based on the charts, I could see the PPO coming back higher, challenging that zero line and rolling over. It kept this trend bearish. So either way, I had outlined in one of my most recent updates in the videos a few weeks back, a scenario where we undercut this previous reaction low here. Right there, you had those previous lows. Undercut them as we did, and then put in a divergent low around this point. And that's exactly what we've done. Now we need to see a reversal. So far, a pretty nice green candlestick today, but we don't have evidence. So I'm not going to add this as an official trade yet, but I do want to show you the 60-minute charts are firming up as well. So there it is. This is what I'm looking for in wheat. It may very well be added as another trade, and this would be, this is a bottoming play here. We have nice bullish divergence on the daily time frame. We had bullish divergence back here. This was an official trade idea, and it hit. You can see the all three targets. We had one back here too. It hit all three targets, divergent low. That's what I do. I try to find these divergent lows, especially when you get them on the daily time frame. We have one here now, potential not confirmed. It might be soon, and I see a lot of upside potential. So there it is. For those of you that gave wheat a little more room, percentage-wise, it's not that far below the stop. Remember, wheat is a fairly low beta instrument. It's not very volatile. So as bad as that looks, you're just over 3.5% below. Actually, as of now, about 3% below where the stop was. So certainly one if you wanted to give it a little more room, and I think it's starting to firm up. Let's look at the futures. All right, this you can see down below. I have it looks like the PPO. Here's positive divergence. You can see here from this point to this point, prices have been making lower lows with the indicators making higher lows. So far, we're moving up off there. Again, there's still work to be done, but I wanted to let you know that the 60-minute charts confirm what I'm seeing on the daily charts. Energy sector, again, one of my favorites recently. I mentioned this one as a somewhat aggressive but objective trade, and with a very high risk reward potential. In other words, but when we were falling here, and I was looking for a potential right shoulder to be formed, I said you could go long when you had roughly had symmetry, pretty nice symmetry on this one. You go long there on the bottom of the formation, especially once you see the reversal, which we already started to see there, and then you can hold that out for a move up to the neckline. And so far, this one's playing out nice. So we're seeing that bullish crossover on the PPO right around the zero line, and if it continues to play out, we're seeing a lot of the criteria I like to see in a Head and Shoulders. You see volume expansion on the formation of the head coming off the right side of the head, and we've seen pretty decent volume so far on this advance off the right shoulder, and we want to continue to see that. That would really help this pattern. We can have a little hiccups along the way. You can see this left shoulder, how it was formed. It's not always a complete up and down. Some might say that's two. You can also have two shoulders. Those are called complex Head and Shoulders patterns if you have two shoulders. Either way, that's just the nature of the pattern is the left shoulder there, the formation of the head, and the right shoulder. So my thoughts here, if and when we get to that neckline soon, will probably be, especially if we do it in the next couple weeks here, will probably be very extended. So I often like to see, and if that is the case, I often like to see a pullback there to help reset or clear out the near-term overbought conditions before an advance, a breakout. And then, of course, a buy signal on a inverse Head and Shoulders pattern comes on a break above the neckline. And this white line just measures that's the distance from the head to the neckline. measured target for the pattern, but these horizontal lines here are my targets, so I expect this thing to play out something like that. So there's one of my favorite sectors right now. And as I mentioned, quite a few names in there. Hal Burton, this one's already reported earnings. This one looks good, and you have a little bit, plenty of room left even on that right shoulder formation. Um, we are a bit in no man's land. No man's land is what I refer to. It's a term I have when you're between support and resistance. I call that no man's land because if you go long there, well, objectively, you can set your stops wherever you want if you want to just randomly pick a number 1%, 2%, 5%. But I like to usually set stops strategically below support. And you can see the bottom of that right shoulder would be support. This thing could even form a complex head and shoulders pattern. I should point that out. You could see a second right shoulder here. It's sometimes you technically speaking, if you get a second right shoulder, you'll go up here, form that, and then you'll come back down, make the other right shoulder. But as you can see here, you can get these little hiccups along the way. So as long as the essence of the pattern here is there, where you have a left shoulder here, a right shoulder here, there's some decent symmetry, anything could happen. So my point being is we may stall out here for a little while. We could head right up to that neckline. I don't know. All I know is it was a good buy here. If that pattern is finalized, your next buy signal is there. Anything in between, we could chop around. I'll have to study the intraday charts, which I haven't done yet, but I wanted to mention Hal's a good one. I also mentioned yesterday Crescent Point Energy, Crescent. And that's another one just beautiful. You had both the bullish falling wedge, these two lines here, bullish divergence at the lows. And again, that one was added as an unofficial trade idea back here right after that broke out. We went on to hit the top of my first target zone, pulled back, and then what that did is put in just a beautiful, so far, a very nice uh, inverse head and shoulders bottoming pattern. There it is. And this one now is all the way up to the neckline. This is your neckline right here. So that pattern is straight out of the textbooks. There's that volume confirmation I like to see. Strong volume on the advance formation of the head and very strong volume also on the right shoulder. Doesn't mean it has to play out, but I can tell you inverse head and shoulders bottoming patterns just don't get any better than that. So there it is. And if that thing breaks out, you can see my first target, which is still the second target of the trade back here after the breakout of the wedge, is just slightly above. But I fully favor this target being hit. If you're a longer term, investor, swing trader, trend trader, um, maybe look for something. There's a lot of possibilities, but a breakout, hit of that T2, come back, test the neckline, and then move up to T3. I think that's a very likely scenario. So that's the couple ideas in the energy sector. And remember, now we're starting to clear out. A lot of these stocks are reported. So just check that. Use that link on the front page where you can check earnings. There's a little search box. Enter your ticker symbol. It'll tell you when they report. And if you don't see them, the report, if it's 3 months away or 2.5 months away, that means they just reported. So you're clear to take a position. Now there's always news events, and when you're trading, some of these stocks in the energy sector, particularly those below $5 a share, even those below $10 a share, there are some issues there, and you could wake up to a stock being down quite a bit. Maybe they have share dilution. They're issuing more shares to raise capital, things like that. So there's always risk with individual stocks. And again, so if you're not comfortable with the overnight risk entailed with trading individual stocks, trade something like a XES or even XOP. They're just different. This one's exploration and production, and they all you have a lower chance of waking up to a big gap down against your position in those ETF. There might be a few other things I can't recall. I didn't usually write down the things I want to cover, and I was just kind of ad-libbing this one today. If there's anything else, I'll make mention in the trading room or the front page. But XBI, I've been talking about recently, had that big pullback. I've covered it quite a bit. I still favor a little more upside based on just how far we came down, how oversold we were, and we bounced off support. But again, it's not a bounce that I care to game. I told you I covered my shorts when we got down there last Thursday to that support level I just had on the daily chart. We're struggling right now. We continue to struggle with the top of this box here. Shows you the former sideways trading range that we had here. So the top of that range was resistance back then. We broke resistance. We came back. Resistance once broken acts as support, as it did here. You can see how long we traded above it. Then we gave it up. And again, it's acting very well as resistance. You see these three little punches through. Those are candlestick wicks, aka shadows. That means on a 60-minute basis, we pierced above but failed to close in every single instance. 1, 2, 3, 4, 5, 6 closes right on that level. So on a scale of 1 to 5, that's a 5 as far as resistance. And as I always say, resistance is resistance until unless taken out. So if they take it out, print a solid 60-minute close, especially a daily close, well, that's bullish, and that would open the door up to a move to, this next level here at 86.60. However, if they fail there, then that's going to be pretty bearish, especially if you see XBI come back down and then print a very solid weekly close or daily, I'm sorry, daily close below this level, about 82.43. We had one daily close slightly below, but remember, I refer to this as a momentum fueled overshoot. And by that, if you're not familiar with that term, when you have a very pretty fast, downward trajectory on a stock or an index, just like you had a strong upward trajectory here, strong rally, you tend to overshoot the support or resistance levels just based on that momentum. So it's not unusual to see a brief overshoot and then prices come back up and regain that support level like we did here. So there it is. So that's still a very significant support level. Now, technically speaking, you want to really increase the odds of a short trade on XBI. If you're looking to short it, you'd wait till those previous lows are taken out as well. So that's the biotechs. But as of now, I'm standing aside just watching that one. All right, let's wrap it up here. Again, Facebook after the bell today, Apple after the close tomorrow. And so, again, any fireworks, they could start tonight with Facebook, but that's one company. But after Apple's out of the way, you have all five FANG stocks behind us, and then the market would have had plenty of time to digest their earnings, and we'll see what happens pretty much next week. Watch into early next week and see how things go. All righty, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.